Most people don't lose money because they chose the wrong fund. They lose because they were taught the wrong definition of safety. They were told that if cash is sitting still, it is protected. If it is in the bank, it is responsible. If they wait until life feels more stable, they'll invest later. That sounds prudent right up until you look at a grocery receipt, a rent increase, a utility bill, and realize your money has been shrinking the entire time without ever showing a red number on the screen. A lot of people hear I have $100,000 and think they resecure. Not rich, not free, but secure. A decent cushion. And this is where people get trapped by a second lie. One that sounds sophisticated. I'm not trying to get rich. I just want something safe, steady, and proven, which is fair. Picture it. One person leaves $100,000 in a bank account. Because they don't want volatility, they feel disciplined. That matters because broad market investing is not a casino bet on hype. It is ownership. That doesn't mean every rosy projection deserves trust. It doesn't mean you should blindly assume the next 30 years will hand you a straight line upward, because they won't. Take the same $100,000 and drop it into FXX. Do this instead of letting it sit still. This fund is not built to impress you with fat payouts. Its current yield is 1.13%, about $2.65 per share per year. And that dividend has only been growing around 3.32% annually. Now run the numbers all the way through. Not just for one quarter, not just for one lucky year. After year one, that $100,000 becomes about $113,900. After 10 years, it is projected at roughly $355,482. By year 20, you are looking at around $1,211,937. And look at the composition of that ending value. Because this is where the illusion breaks. Nearly $4 million in total value, with around $3.91 million coming from capital appreciation, and only about $50,315 from reinvested dividends. By then, the annual dividend income is only about $2,290. Now widen the lens. What if the issue isn't just growth versus income? What if it is really about concentration versus coverage? FXX gives you the 500 largest U.S. companies, but FERS pushes further. Instead of owning one important slice of America, you own thousands of businesses across the entire market. And then there is the second proof, the one people underestimate. Because it sounds too boring to matter, cost friction. FXX charges a true 0.00% expense ratio. No management fee, no silent skim. Every dollar stays in the portfolio instead of leaking out. Over 1 year, that sounds trivial. Over decades, it compounds exactly the way games do. Performance-wise, it delivered around 96.33% over the past 5 years, which is slightly behind the S&P 500. And this is where impatient investors often make the wrong conclusion. They see slightly behind and assume inferior. But FXX was never designed to mirror one narrow segment. It was built to reflect the whole U.S. market. When large cap growth cools off, mid caps and small caps can take over part of the work. The current share price is around $23.52, which also destroys another common excuse. You do not need thousands of dollars to begin. A small amount still buys exposure to almost every major company in the country. So when people ask whether this only works for someone starting with 6 figures, the honest answer is that the mechanics are identical. The scale changes, the logic does not. If $100,000 compounds, then $20,000 compounds. If $120 a week compounds, it obeys the same laws. Smaller inputs don't break the machine. They just produce smaller, early numbers, which is exactly why so many people quit before the curve bends. As for risk, FXX behaves a lot like the S&P 500, but with slightly more volatility because smaller companies are included. That extra movement scares people in the short term and rewards them in the long term, especially during expansions when mid and small caps can grow faster. faster than the giants everyone already knows. So, no, the smoother-looking path is not always the richer one. Sometimes, the extra wobble is the price of capturing a fuller share of economic growth. And even on the income side, which people love to use as the shortcut test, Frox offers a 1% dividend yield with a much stronger 7.55% dividend growth rate. That combination tells you something important. The payouts may start modestly, but the growth rate changes the future faster than most people realize. So, before you say, a fund doesn't pay enough, ask yourself a harder question. Are you measuring today's tiny cash stream, or the size of the snowball that cash stream is attached to? Which one matters more to you right now? Most people hear a number like $5,196,450 and immediately think the lesson is work harder, save more, be patient. That is only half the story. The deeper lesson is ownership, because the biggest split in personal finance is not disciplined people versus undisciplined people. It is people who spend their lives feeding assets they don't own, and people who slowly collect assets that keep paying them back. Look at what that means in plain terms. One person wakes up, checks their phone, and sees money leave their account all month long. Rent, car payment, insurance, groceries, utilities, interest on a credit card balance they meant to pay off sooner. Every dollar they earn arrives already claimed by somebody else's asset. Somebody else owns the apartment building, somebody else owns the bank, somebody else owns the utility company, somebody else owns the businesses setting the prices. That person is not just paying bills. They are financing the income stream of people on the other side of the statement. Now compare that with what happens when the same $100,000 is placed into something like FODSROX or FSMDX, and then left alone long enough for ownership to matter. In the FODSROX example, the portfolio is projected to move from roughly $113,930 after year one to about $361,710 after 10 years, then around $1,270,100 by year 20, and roughly $4,385,315 by year 30. In the FSMDX case, the path is even more revealing. About $112,260 after the first year, roughly $330,200 after 10 years, around $1,213,483 after 20 years, and nearly $5,196,450 after 30. Same world, same inflation, same grocery aisle, same housing market, but one person keeps getting price increases as pain, while the other increasingly receives them as participation. That is the hierarchy. Almost nobody explains clearly. At the bottom are pure labor earners with no productive assets. They trade time for money, then lose most of it to rising living costs. Slightly above them are savers, who do the responsible thing and accumulate cash. But their money sits still, while everything they need gets more expensive. Above that are partial owners, people with a modest claim on businesses through broad funds. They still work, still pay taxes, still deal with inflation. But now they have something on the other side of the transaction. And that positioning matters more than motivation slogans. You can be incredibly disciplined and still get systemically drained. If your entire financial life is built around servicing obligations instead of accumulating claims, the system rewards ownership first, effort second, which sounds harsh, but watch the mechanics. That means when people book cruises, swipe cards, or pay cloud software bills, or reserve hotel rooms, or use financial platforms, the revenue doesn't vanish into abstraction. It lands somewhere. This is why the usual just budget better advice feels so insulting to many people. Budgeting matters, yes, but budgeting alone cannot overcome a broken structure, where your paycheck enters as labor income and exits as someone else's return on capital. If all your financial energy goes into plugging leaks while owning none of the pipes, the game stays tilted. You can cut subscriptions, meal prep, and delay vacations, and still find yourself running on a treadmill that speeds up every year. Meanwhile, The person holding productive assets experiences the same economy in reverse. A market dip looks scary, but they still own underlying businesses. A dividend looks small at first, but it grows. A 2.28% yield doesn't sound life-changing today. Yet when that income stream grows and gets reinvested, it begins buying more shares, which then produce more income, which then buy even more shares. That is how time turns a quiet position into a different class of financial experience. Not overnight wealth, not fantasy returns. A shift from being harvested by the system to having at least a partial claim on what the system produces. And that is also why the obsession with finding one perfect ticker misses the bigger point. The real issue is not whether a fund sounds exciting. It is whether your money remains trapped as idle purchasing power or gets converted into ownership of cash-generating enterprises. The person with no assets argues about inflation. The person with cash fears inflation. The person with ownership adapts to inflation far more effectively because they are connected to the earnings engine underneath it. So before you ask which fund is best, ask a harder question. Right now, in your actual life, how much of your monthly outflow is actually helping build your own future income? And how much is simply feeding institutions, landlords, and lenders, and companies you do not own at all? That answer tells you your financial class position more honestly than your salary ever will. And once you see it, you stop treating investing like a side hobby and start seeing it as a way to move one layer up the food chain. If you've ever felt like you're doing everything right and still falling behind, this is probably why. You were told to focus on income, but not enough people told you to focus on claims. Claims on profits, claims on growth, claims on distributions, and claims on future cash flow. That is the layer where the sorting happens. So be honest, are you mostly paying the owners or are you becoming one? The mistake people make right here is not choosing the wrong fund. It is trying to solve a 30-year wealth problem with a one-time burst of enthusiasm. They hear numbers like $7.97 million or $57,751 a year in dividends, or nearly $4,729 a month by year 30, and the brain instantly jumps to the fantasy version of investing. Pick the perfect ticker, dump the money in, and let destiny handle the rest. That is exactly how old habits survive. Because in real life, the portfolio usually loses to the checking account. The impulse purchase, the I'll invest it next month delay, and the cash that never leaves the sidelines. So if you want a practical move instead of another motivational speech, make the system brutally small. Open the account first, then set one fixed automatic transfer for the same day every single week. Not when the market feels safe. Not when you've read 3 more articles. The same day, same amount every week. And yes, small on purpose. If $100,000 is already invested, fine. But your habit is still being tested by the next dollar, not the last one. If your budget can handle $120 a week, use $120. If it can only handle $25, then use $25. The amount is not the point at this stage. The point is to remove negotiation. No monthly decision, no heroic discipline. No pretending you'll manually buy after paying rent, the credit card, the streaming subscriptions, dinner out, and whatever random charge hit on Thursday. You want a transfer so boring that it feels beneath your attention. That is the standard. Because once money requires a fresh, emotional decision, it becomes vulnerable to headlines, fear, ego, and procrastination. Picture the mechanics. Payday hits. Before that money blends into groceries, gas app charges, and the 1,000 invisible leaks that drain a bank account. A fixed amount gets pulled automatically into the investment account. If you're using retirement space, direct it there until you hit the limit. If that space is already full, use a regular taxable brokerage account and keep the process going. Separate the account choice from the habit. People freeze because they think they need the perfect structure before they begin. They need the money to stop sitting in cash. While they overthink tax wrappers and future return assumptions, the account can be optimized. A missed year of contributions cannot be recovered nearly as easily. Now make the second rule even more mechanical. Reinvest everything by default. Dividends are not snack money. They're not a reward for being patient for 6 months. In a fund where reinvested dividends can add hundreds of thousands, or in some cases over $1 million across decades, turning that stream into spending money too early is like tearing bricks out of the foundation because the house finally looks tall enough. Let the dividend buy more shares. Let those shares throw off more dividends. Let the machine stay closed. You're not trying to feel rich in year 3. You're trying to stop sabotaging year 30. This matters even more when a fund sounds exciting for the wrong reason. A sustainability fund like Fidelix can tempt 2 different kinds of self-deception. One person buys it because the story feels morally clean. Another buys it because the recent growth numbers look irresistible. Both can still fail if they keep checking the app every afternoon and treating normal volatility like a character test. So create one more dull rule. You only look at the account once a month, on a scheduled date for 10 minutes, and that is it. Not during lunch because Nvidia moved, not at midnight because the market opened red overseas, not after a scary headline about recession, rates, elections, or a lost decade. If the transfer went through and the dividends are reinvesting, then the main job is already done. Constant checking does not increase returns. It increases the chance that you interfere. That is the whole point of a real wealth habit. Not brilliance, not prediction, just friction removal. One transfer date, one contribution amount. Dividend reinvestment switched on. One monthly review window. 4 unglamorous settings that cut the oxygen supply to the behavior that keeps most people poor. Hesitation, tinkering, and emotional spending dressed up as caution. The market may not give you a smooth line. Some 10-year stretches will test your patience. Some funds will stall, and some years will make the long-term average look like a complete joke, which is fine. Your edge is not that you can predict the clean energy cycle, the next healthcare winner, or whether tech leads for another decade. Your edge is that your money keeps moving while other people keep debating, and that creates a very different relationship with every dollar you earn. Instead of asking what to do with this extra money, the answer is already decided before the question shows up. It has a lane, a destination, and rules. That is how ownership starts becoming real instead of aspirational. Not with a grand reinvention, but with one repetitive action that keeps firing when you're tired, distracted, skeptical, or unimpressed. So here is the only question that matters at this point. What weekly number can you automate today and leave alone for the next 12 months without negotiating with yourself in week 3? Here is the part nobody glamorous wants to say out loud. The point of a plan like this is not to promise a heroic ending. It is to keep you from being forced into a bad one, because a chart that climbs from $100,000 toward numbers like $468,000 in 10 years, over $2 million in 20, or $10 million in 30, it seduces you into believing the outcome is guaranteed if you stay the course. It isn't, not in a straight line, not on your preferred schedule, and definitely not without periods that make you question your own memory, your own discipline, and every sentence you ever heard about long-term investing. That matters, because a concentrated growth fund doesn't test your intelligence first. It tests your ability to survive when your account is down hard, and your phone is still lighting up with rent, insurance, groceries, and tuition. The kind of ordinary bills that never care if the market has a bad quarter. If your investing strategy only works when markets are smooth, then you don't have a strategy, you have a story. And stories tend to break right when cash pressure shows up. So the real promise is smaller and much more useful. If you build this correctly, you buy yourself time. You buy distance between market volatility and your real life. You stop demanding that one fund solve every problem at once. Growth can stay in the growth bucket, and income stays somewhere more appropriate. Your emergency cash stays boring on purpose, and your retirement accounts do their job. Your taxable account does its job, and those are not minor details. That separation keeps one rough decade from turning into a personal financial emergency. Look at the actual mechanics, because this fund barely yields anything. The dividend is tiny and most of the return comes from price appreciation. That means the dream scenario is not a monthly payout machine. The dream scenario is that years from now, you own a much larger asset base than you could have built from savings alone. Very different thing. And if you confuse those two, you'll eventually start selling growth assets to fund short-term needs. And that is exactly how compounding gets interrupted. Not by math, but by life. This is why the more serious question is not if this becomes $10 million. The more serious question is if you can hold a volatile tech fund for the next 10 or 12 years without needing to rate it. The first time the market punches you in the mouth. If the answer is no, that is not failure, that is useful information. It means your position size is too large, or your cash buffer is too thin, or your expectations are built on a fantasy growth rate, one that only looks clean inside a backtest. And that is where adults separate from dreamers leaving an exit without self-destruction. They do not go all in on a return assumption. They do not anchor their future to one perfect line on a chart. They scale contributions to a level they can repeat when headlines get ugly. Maybe that is $120 a week, or maybe it is less. Maybe you have $20,000, or maybe $100,000. Maybe more than your retirement accounts can absorb, and you need the overflow in a standard brokerage account. The account type matters, taxes matter, and risk concentration matters. But the first rule is still the same. Never build an investing plan that requires emotional perfection, because compounding is not a lottery ticket, it is a survival reward. It pays the people who can remain functional, while everyone else keeps renegotiating with fear. And that, in finance, is real freedom, not maximum upside. It is about exit rights and breathing room, the ability to say that I don't have to sell today. If you had to design your own version of that buffer, what number would make you feel untouchable? 3 months of expenses, 6, or a full year?